Welcome to the first episode of our brand new education series for technical analysis by Softlogic Stockbrokers. This education series will focus or seriously be catered towards beginners that want to start their investment journey in the stock market, and will take you from learning the very basics of technical analysis to advanced concepts so that you can utilize the principle or the method of technical analysis in your investment journey to invest better. Going forward, we will also have live updates and ongoing market analysis for you with you live so that you get the hang of how to conduct technical analysis in your investment journey and make it a core part of your analysis approach when choosing or investing in the stock market or any other markets in the future. So let's get started. So what is technical analysis in general? I think you've seen it everywhere. You've seen it in the stock market. You've seen it through reports. You've seen it in the global markets. So what is technical analysis? As a definition, it's a methodology or an approach used to forecast future price direction based on us studying past price action, primarily price and volume in itself. So when we look at a chart, or when you look at the stock market, or when you see CSA in general, you probably see that you see many stocks going up and down in prices, and you probably have thought at least one time in your life that am I able to, is there anything behind this actual price, underlying price, that I can analyze that helps me get an upper hand in investing? And that is where technical analysis comes in. We analyze past price action data or past data of a stock's price, right? And use that price and use our analytical approach to predict how that certain stock or counter or an index will perform in the future. To leave a note here at first in itself, yes, it is subjective compared to fundamental analysis, because fundamental analysis focuses on economic factors, company health, industry conditions, and macroeconomic indicators. And it's more structured and more, there are standard steps into doing analysis, and there are standard and accepted methods of measurement for fundamental analysis. But when it comes to technical analysis, while there are principles that we follow, while there are more recognizable or reputable approaches that a lot of technical analysts take, it is subjective because which we'll explain later, but because we are explaining, or because we are dealing with human biases and human behavior. So the differentiation between fundamental analysis and technical analysis is that fundamental analysis takes a more standard approach, but technical analysis uses learnings from 200 years ago to understand how do we use past price action and add analytical approaches to that past price action, and use different methods to predict future price action, so that not only can we get an edge in the market, but also risk manage, which we'll talk about more in the next slides. When it comes to technical analysis, we have a certain set of assumptions that we take into our analytical approach when we are looking at a certain counter, stock, or index, right? And these 6 assumptions are key for you when you are starting your technical analysis journey. Let's go through it. And what are them? Why do they matter? The first assumption that we make in technical analysis is that the market price action discounts everything. So that means that whenever you see price being generated or price being priced into a certain stock on a certain day, The assumption behind technical analysis is that the market, the overall market, each and every single investor's biases, information, and inside information also gets priced into that certain day's price, because there are different types of investors in the market, from smaller investors to large investors to investors that we call whales, and all of these investors are segregated or have different levels of information. But the assumption that we take into technical analysis is that the market discounts everything. So when you see a price being, for example, XYZ stock at rupees 50, that rupees 50 price has been priced in all the information that the investors know, different types of investors, has been priced into that pricing, which gives us an edge where when price, and if it stays priced in and information does not change and human biases does not change, the assumption is that price should not also change. But what happens is, because human biases change, because human sentiment change, because information and speculation comes apart, that's where price tends to go up and down. And that's the differentiation between you seeing a search and research firm saying this stock is undervalued or overvalued from a fundamental point of view. But you also see that price does not just go to that level, or price might not even reach that level, or price might even exceed beyond that level. And the basic reason behind it is because human sentiments, different information that investors have, or we like to call it asymmetric information, comes and takes an action in that price movement. The second thing, or the second assumption that we make in technical analysis, is price moves in trends. Because of thorough research on human mentality, researchers have found that a lot of the investors in any market, especially the stock market, have a herd mentality, which brings about this assumption of price moves in trends, where price tends to act or move in a trend, at least in a shorter time frame or in a larger time frame. This can be a larger uptrend in an year, or when I say uptrend, that means an upward movement, right? Or a larger downward movement within a year, and that's a trend. And then that's there, because of technical analysis and because of the current technology, price can be viewed into every second, right? So there, under the assumption of price moves in trends, there's also a sub assumption that we make that price, or that every price action has trends in shorter time frames and longer time frames, where this can be in a weekly time frame, right? On a weekly basis, price is moving higher, but on a daily basis, or on an hourly basis, price is moving down at the moment. So there is trends in different time frames, but the basic assumption towards our approach to technical analysis is that price moves in trends. And the third assumption is prices are non-random. If prices were random, then that means that we would not be able to predict or anticipate future price action or future price targets. But because we believe or assume, based on a lot more research having done in the past, the assumption that we take into technical analysis is that prices are non-random. Because human behavior, I think you've heard it in the past, or maybe you haven't, right? History tends to repeat itself, not in exact manner, but most of the time. And that is the third assumption and the fourth assumption are kind of tied in together, because why both things happen is because it's the same investor, it's the same group of investors with the same sentiment or same biases that are dealing in the market. So you tend to see same kind of trends in price action or in buying volume or in sell volume, and that's where patterns start to develop. And that is how we anticipate or identify patterns and predict future price action or even risk manage using technical analysis. And that is why prices are non-random. And that is why history tends to repeat itself more often than not. Fifth assumption is an obvious assumption where for you for count or stock XYZ stock to go up, there needs to be buy volume, then sell volume. There needs to be 100 buyers bidding 100 shares, and there needs to be 50 buyers, 50 sellers asking or bidding, I'd say, or wanting to sell 50 shares, where there is higher demand on the buyer's side so that they can push price higher because they demand more and more shares of a counter. And that is one of the most fundamental principles of technical analysis, where you would understand that price moves up and down because of supply and demand. And the sixth assumption of markets being fractal is kind of tied into the second assumption of price moves in trends. When we say markets are fractal, that it is exactly what I meant, where you can have a trend, a different trend in a 1 year horizon. Like when you zoom out and look at a counter or share from a 1 year or a more longer term horizon, the trend can be downward moving, where the XYZ counter or share has been moving downwards over a period of a year's time. But because markets are fractal, the share can have an upward movement for the past couple of days. And that is a different trend when you take a weekly time frame. And if you analyze the counter from a weekly time frame, you would probably see that, okay, the counter or the share is having an upward trend in the short term. And this is where the birth of day trading, mid to short term trading, long term trading comes in. And this is why different type of investors are also born, because based on your risk management or because based on your risk appetite, if you are a person who likes risk, if you have a high risk tolerance, you'll probably be a day trader seeing the trends in the short term time frames and trying to capitalize on short term gains. But if your risk appetite is a bit more longer, shorter, and you are a risk averse person, you probably want to invest for the midterm to short term, looking at the mid to short term trends. And that is where the markets are fractal assumption comes in, which gives an opportunity for the birth of different types of investors. Technical analysis in general, right, has obviously, just like any other analysis method in the history, or that is any other analysis method that is being used right now, has a beginning where it got started. And for technical analysis, it's one of the pioneers of technical analysis is someone called Charles Dow. You may have heard him as the co-founder of the Dow Jones Industrial Average, which is one of the biggest indices in the US stock market. And Charles Dow laid the groundwork for technical analysis in the early days. And if you want to dive in deeper, you can read his book on Dow theory, which gives you a good idea of how the technical analysis approach has been built on, and how there has been multiple studies done on technical analysis, and why we've used these previously mentioned assumptions as it is. And even though some of the teachings or methods that Charles Dow used has been advanced or has been built upon, his methods have been used as a key foundational structure for us to do technical analysis today. So he is one of the early pioneers of technical analysis, and we will always be indebted to him for taking this effort and building this analytical approach forward. And of course, as time passed on, right, there was more and more people that did research on technical analysis and that helped technical analysis move forward. And with technological advancements and the rise of computer-based trading systems and online trading platforms like A-Trade that we use today, we are able to trade and transact in a much more swifter manner, which gives the opportunity for investors to act on certain information or buy or sell a share instantly. And this is where certain patterns that you might have seen or heard arise, because investors now have not only have the information or the lack of information which will compel them to act on their emotions or sentiments, but also the infrastructure to take action. And when those two synergies come together, you get a lot more patterns being developed in the market, a lot more seriously informed investors trying to get a competitive advantage by deceiving the market, and also just the average investor who just wants to make a profit. And if you use the technical analysis method properly, you get that competitive advantage compared to your peers, where you would be able to not only get a competitive advantage in terms of being positioned at lower prices or being able to get into counters or shares at lower prices and experience and realize higher gains. Not only that, but also risk manage, where if an investor with a higher amount of information is acting against you, you still be able to use not only the fundamental approach, but also technical approach, where you'd be able to risk manage and save your realized gains or save your gains or save your portfolio from witnessing a drawdown. And like I mentioned in the past few minutes, right, the importance of technical analysis comes down to a few key things. The first thing is it helps you forecast. We look at past price action, we look at past price patterns, and it helps us and gives us an idea of what would happen in the future. And yes, it is subjective, but because a lot more people are following some standardized processes or standardized approaches in technical analysis also, most of the time these subjective analytical methods also come to inherent fruition, where you probably see whenever we expect a certain thing to happen, if you are using the correct steps, you probably see price in itself achieving it, or at least going closer to those targets, whether it's upward or downwards, and it will help you become a better investor. And the second important thing about technical analysis is not only does it help you, like I mentioned, to predict and capitalize on trends, it also allows you to risk manage, where if you are in account or if you have bought a share, where do you cut loss? What is the step what is the level of price where you should take some profit? Or what is the level at which you should get into a counter? Or what is the level at which if the whole market is trading against you, where should you enter and exit, right? And that is a very, very important edge in the market, where fundamental analysis gives you an idea of what to buy. Is very important. Fundamental